with Bob Brooks. It's sponsored by the Prudent Money Foundation on 91.3.
Came in hot this morning, so what does that mean? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me today, you can always go to the website at www.prudentmoney.com. Just send it in and we'll get it taken care of for you. That's all at the website, www.prudentmoney.com. Well, today was the day that the latest inflation numbers hit the news wires, and watch everybody react to them. And unfortunately, on a 12-month basis, meaning last August through 12 months from last August, the headline inflation number, because remember there's two parts to the inflation number, but the main headline inflation number was up 8.2%. This was more than what was estimated to be the increase. Now you could look at those numbers and you could say, well, yeah, definitely it's going to be higher just because energy cost, the cost of oil, has been going up just as of late. So that in itself is probably dragging the inflation numbers up. And of course, you're getting more widespread inflation and hitting to where it's covering just about every aspect of the economy. It's off of the peak. So the June 12-month number was 9%, and this one's 8.2%. And I probably could almost guarantee that's what President Biden and everybody else in Washington will say is, well, but look at the headline number and look at where we came from, and it's definitely going in the right direction. Yeah, I don't think that's actually that true. Now, if you take out food and energy prices, so if you take out the money that we spend on anybody who breathes, is going to eat food, and everybody that drives a car is going to is going to deal with energy prices. The core consumer price index accelerated 0.6% with an estimate of from the economists of only 0.4%. So this is core inflation over the past 12 months was the biggest 12-month gain since August 1982. Now, keep in mind, we're going to see a lot of fluctuation. We're probably going to see the price of oil continue to go up, and what that does is that starts to pressure gasoline prices, and gasoline prices goes up. I know that just a joy to be around this morning as I spread good news. But that's just what the price of oil. Oil is going to be a very volatile market. And it definitely creates some volatility for the CPI. Now, remember what I told you the other day, that gasoline prices in 2008 had become very unmanageable and out of control. The price of oil was up at record levels, much higher than it was this time around. However, the government has ways of tinkering with the price of oil to go up or go down, and the way that they did it back in 2008, the price of oil just actually crashed. But here was the time frame that this happened, and a lot of this, of course, there was a midterm election, imagine that, in the month of 2008. I mean, in the year of 2008. So March of 2008, the price of oil topped, didn't go any higher, and started to decline, and actually really started to crash. Fell way lower, down to the bottom in September, then started moving again, back up. And I can't make this up. Guess what has happened this go around with a midterm election here maybe 3 weeks, about 3 weeks away. March, the price of oil topped, has gone down until September and started to go back up again. I don't know, call it coincidence or call it intentional. Who knows? Who really knows? But anyway, look for the price of oil to continue to go up, starting to influence gasoline prices and how that will affect the CPI. But the thing is, the CPI, Consumer Price Index, which measures inflation, is bound to go higher because I don't think that we've seen the full effect of inflation yet. And at that point, we should see the CPI settle in kind of at a level and run along the side of the economy for that level for who knows how long. And that's the problem. We see what'll end up happening is the CPI will go up to probably over 9% at some point, and then it'll start going down. And everybody will praise the inflationary situation is over. The inflation prices are going to start coming down, and a little bit of that will happen. But I think what the ideal, of course, is for it to go down quicker than it went up, and to continue on that trend of going down. The problem is that this type of inflation that we have today is so complex that it may be kind of stagnant at levels that are much higher than we're used to. It's just like inflation today, what you're experiencing. How many people can go another 1, maybe 2 years with gasoline costing higher gasoline prices, with food costing what it's costing, with just generally prices up over everything? And as we've discussed, the true inflation rate is probably over 20%, not this number of 8.2%. I think that's kind of government numbers for you. I saw a study on the price of, on inflation, that back in the 70s and early 80s, inflation was way out of control, and they said the study said that if the government were to calculate inflation as it did in 1980, when it was a real problem, our headline number would be up 17%, which is probably more in line with reality. But it is what it is. I think that what we want to see is the cost of goods really start to fall and continue that trend forward down to below 2%. But I think it's a lot more complicated than that, unfortunately. And so interest rate increases, are they working? Well, they're obviously not working. Now, keep in mind that the Federal Reserve Board, just think of them as a big bank, the biggest bank in the world. They control all the banks. Has been raising interest rates for, I can't even think back how long now, and yet we still have inflation running out of control. So it begs the question: what are they? Is what they're doing, is it actually working? Here's the problem with interest rates. Interest rates have been so low. I mean, zero is pretty much about as low as you can go. I guess you go negative. I really believe it would take a big, big jump in interest rates to have any kind of effect on certain parts of inflation that are influenced by an economy that's slowing way down because of high interest rates. I hope that makes sense. So, for instance, mortgages are near a 7% interest rate. That's pretty quick to get up there as quickly as it can, as quickly as it has. And you got to think of what that's going to do to the market and what other potential other problems. I read something where people are getting these real high risk type mortgages because of the 7%, because of mortgage rates are going up. So people, it affects consumer behavior to the point where people will make decisions and take risks that they normally would not take risk. So definitely want to keep an eye on that. So back to our interest rates working. Interest rates are designed to slow the economy down. Well, when you have a complex type of inflation like we do, there's other things that are bringing the cost of inflation up in this economy that interest rates are not going to really have an effect on. So there is the rub. What they don't tell you in the media, but there is the rub. So you get this stagnant level, let's say at 7.5% inflation. Well, that's not as high as it has been, but it's 7.5% that continues to. It's like a hurricane continuing to pound and pound and pound and pound a coastline. Same thing with this until it really goes down and fixes it. So I had to, and I try not to watch a lot of CNBC because it's pop culture finance at its finest. But they had a money manager on this morning, and the money manager was talking about inflation. And she said that you've got to look at this as a transit. She actually used the word transitory period of time before it goes down, and it will go way down. It's not going to last. You got to be a long-term investor. Now let's dissect that for a second. If you look at the consumer price index dating back to the 1900s, the on a graph, you'll see the index go way, way, way up, then drop way, way, way down. It's almost like a spike versus a situation where things are level, like I've been talking about, a level inflation rate that's higher than we're used to. Of course, in the future, this inflation issue will not be a big deal. It will go away. It's just like having a bad, probably pneumonia, because pneumonia is one of those things that can last. The remnants of pneumonia can last for a very long time, and you just think it's never going to go away. Then finally, it ends up going away. Same thing with inflation. So long term, yeah. What is that? What is telling that to an audience on CNBC? Something that's really a big help. But once again, I talk about that because it always comes back to, don't worry about it, you're a long-term investor. Well, yeah, and long-term inflation won't be a problem, but how much damage is it going to do in the next 4 to 5 years, 3 to 4 years, 2 to 3 years, 1 to 2 years, however long? Therein lies the question that plagues most people. Sure, long-term, you'll probably be okay. Who knows how to translate that into a number of years? But at the same time, it's going to do some damage to the markets. And let's talk a little bit about the markets. we're going to see a lot of, and there's two ways I want to describe this. As Pop Culture Finance talks about it from the standpoint of strictly volatility, big word. That means the market's going to be up and down and like crazy. And volatility is a real thing. We've seen a lot of volatility today. We'll see a lot probably every day this week where the market makes extreme up and down moves. Just enough to get you and your anxiety level up. Now, there's a second thing called a trend. Where is that price trending? Direction? Where is the price level of the stock market going? It's trending down. Volatility makes it sound like it's just going backwards and forwards and not going anyplace really, but it's not going down. The markets are going down or have been trending down. Yeah, we're going to have up days, and that's going to fool people and think it's all over. But it's just going to be a lot of volatility. But the market looks at it this way. It's always about what they don't know is the problem. Well, what we do know is that the Federal Reserve Board is going to continue to raise rates. That's going to negatively or should negatively affect the economy, and it should slow the economy down into the recession that we're already in. Now, we talk about this all the time. 2 quarters of negative growth in the economy equal a recession. Been that way for decades. We've had a negative quarter in first quarter this year and a negative quarter the second quarter of this year. And the third quarter we will see within a couple of weeks. Towards the last week of October, they'll announce whether it was negative or not. The definition of a recession has been the same for as long as it's been around. But all of a sudden, this isn't a recession. This is something else. We're just slowing down. The numbers are wrong. The numbers are wrong when they're not convenient. The numbers are calling for, and the numbers are always a little tainted by government accounting. They're trending in the wrong direction. They're going down. They were a surprise number that's going down. And I couldn't believe how many economists were like, "Oh, I didn't see that coming." Well, it's there, and it is a recession. We are in a recession according to the rules and the definitions that we followed for many, many, many decades prior to this, unless you want to conveniently change it. Now, here's the thing. If we come out with a positive, even 0.1 of a positive growth number, we will be in a situation where the politicians can say, yeah, you see, there was no recession. And that will make my head hurt, probably, because they'll just ignore the first 2 quarters. But hey, that turns the corner right into the midterms pretty well. We'll see what comes out. But the inflation number is definitely high. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. A couple of things. First, if you have a question for me about anything, send it on in. Go to prudentmoney.com, and I'll answer for you. Or you can send one through info@prudentmoney.com. However I can help, want to be able to help, and love to get your questions. But you know that. So the questions, obviously, I want to hear from you on. Second, I would say save the date, but I'm not sure when it's going to be, but it's going to be within the next couple of weeks. We are trying to get together a webinar that I think will be a great investment of time to sign up for. If you've been to any of my webinars, I keep them under an hour, most of the time under 45 minutes. This time I really want to make sure that we've got a good, strong Q&A session afterwards. But I'm going to be focusing on, and I don't know if it's 5 or 7, may even be 10, questions that you should be asking. When I talk to people, we go through everything and they'll say, that looks great. Let's, I just feel like I should be asking something. What questions should I be asking? And I think that is a lot of where people are today. What questions should I be asking? And then what are the answers to those questions, and how does that reflect on what I should be doing? The way to survive and even thrive through a market situation like we're going through is that you ask the right questions and that you decide either not to take action based on a lot of homework, a lot of prayer, a lot of time thinking and studying about it, or that you need to take action as well. Not delaying or not taking action by default. Most people take action by going, if you still get your statements mailed, taking that statement out, walking in the house, throwing it in a desk drawer and shutting it, and going on with your day because you don't want to look. I get that. It's a strategy, not a very, very good strategy, but it is a strategy. So just look for more information, more details. We'll probably do it like we always do it, and this time probably just a Wednesday and a Friday. More than likely, not next week, it's too soon, but the week after. So I will get all that information out probably by Monday of next week, and we will talk. And I love to do the webinars, and love to interact a little bit with you. And and once again, always it comes down to see what you're thinking. One of the biggest blessings that I can think of in getting to do what I do is that I get a front seat on the front row and get to watch what happens. I get to talk to people. I get to see what's going on in their lives. I get to see what their perspectives are, what they're concerned about, what they are hopeful for, just everything. And I bring that back to you in the form of content, created content. And like I said, it's a blessing for me to get to do that. I really feel much very appreciative of the ability to get to do that. So we'll just look for more information. I'll be getting back to you probably on Monday, and we can get you all signed up for it. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. I do I appreciate it. One thing that I do want to apologize for, I have been slack. I've just not been writing many blogs lately. Sometimes time has to give somewhere, and that's the problem. So I'm making a commitment to getting back on the blog writing process, and plan to do that maybe even today, roll one out and then start rolling them out during the week. So I do apologize that it's not that I'm going to stop doing it. It's just that I've had to temporarily stop doing it here just recently. So look for that as well. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com. Send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.